page, maybe like simplepassivecashflow.com/tax. And as I find things, I'll just add it to this. Right now, there's session 1, 2, and 3 on there. Some notes, and then the Google document that we've all been adding to these last few weeks. I'm going to add that to the website here in the next few days. So if you don't see it anymore, maybe just shoot me an email and I can add it into there. Again, a lot of stuff in here. Oh, yeah, there is a lot of stuff. So I would recommend taking a read through this thing. But here I am at January 18th. Today's last session is going from chapter 16 all the way to the end. I am going to kind of just roll right through my notes here. And if you guys want to stop me and we want to have a discussion on this stuff, feel free to. But yeah, we'll try and get everybody off on their weekend, long weekend, hopefully, if you don't work Monday. So any thoughts before we get going? All right. So page 170, they started to talk about insurance or the umbrella policy as the first line of defense. And I felt like, the book was an asset protection, or is not an asset protection book, it was more of a taxes book, but the strategies can commingle and they can sort of inhibit each other in such a way. So you can't really talk about one without the other, but it started to kind of talk about that. Page 171, it points out that the United States is not a loser pay system if somebody does a frivolous lawsuit. So that's something to be aware of. And then also started to talk about offshore entity structures, such as the Cook Islands, is what I hear a lot. Don't take my word for it. From what I've gathered, until you're above, if you're just a passive investor, maybe not like a doctor that has a higher liability, I don't think you should be really thinking about an offshore account until you start to hit $3 to $5 million total net worth. They usually cost in the range of 30 grand. But they sure are funny, right? When somebody wants to sue you, now they got to go get a lawyer in the Cook Islands. and not work off those contingency fees or retainers. So it's pretty ironclad, that stuff. But I would suggest equity stripping and sort of an irrevocable trust if you're around $1 to $2 million net worth. Any questions there? Any thoughts there? All right, page 176. They talk about this charging order protection, and I think this is a really important point. So if somebody sues you, it basically immobilizes your business moving forward. I was just talking with a guy, they're in a lawsuit, and they're likely to just settle. But the problem is they're trying to close on another deal, and that kind of ties up everything. Can't get a loan. So sometimes that's the biggest issue, and somebody might just put a lawsuit on you knowing that you're going to be doing something, a big deal, because now you're more at a place to settle with them, right? Even though you may not be, if that wasn't in play, you totally just see this lawsuit out and settle for pennies on the dollar. Just something to be aware of. And he talks about several states, Wyoming, Nevada, Delaware. I'm not sure which is the one. I think that's when you got to get your lawyer in, because this is determined by more case law than anything. Anybody want to add anything onto that?
No, that's pretty much spot on.
I had a question about kind of the next section. That they say if you lose a case with an LLC, that's of course the idea is that they should be able to get your cash flow, but he says, I, as the manager of the LLC, will not allow any cash flow to be distributed to me when I know that they're going to get the money. It seems a little, do you know that actually works? Have you heard of a case of that actually working in practice? It seems a little bit, I don't know if I'll say devious, but
well, Just
redirecting your funds.
so I can kind of reiterate for the group, just said in a different way, like you can structure your asset protection trust to say, hey, if someone's going to sue me, this LLC closes up, and in duress, I'm not going to pay out. And this is LLC talking here, but you control the LLC or the trust. I understand it. It's legit. If you really wanted to test it and you wanted to throw, it depends if how much you want to throw at it, right? To fight it on the other side. I mean, at some point, you throw enough grenades and bombs over at it, it's going to cave in. But that's the other thing. You want to deter people from going to war with you. I've even heard of things like what they call like 24-day Cook Island Trust. It's not a Cook Island Trust, but in 24 hours, it can sort of be transformed into one. So if somebody comes to sue you, you just turn right back around. You tell them, hey, guess what? You got 24 hours. You better settle for pennies on a dollar or you're screwed. You got to go to Cook Islands. But they could still fight you there, right? But no one in their right mind would really want to do that.
Yeah, because they really can't make you pay yourself so that you can pay them. So that's the whole purpose of it.
Right. So as long as you're arm's length here, right, Greg? Like as long as you don't own this LLC. And I think that's the key distinction. If you control it and you don't own it, that's the big thing. Like I think that's the Rockefeller's quote, right? Own nothing, control everything.
Control everything, right?
The cars you drive, the assets you own. Like think of all the trust fund kids, right? When they go out drinking and driving, doing whatever, they don't own any of that stuff. They control it for sure.
Yeah.
So moving on to, there was a discussion in the book on different retirement accounts. I put my blurb right there, what I think about the whole investing in, the whole UDFI discussion there. You guys can read about it. We've probably talked at some point about this. Solo 401ks, QRPs. If you want to get that book, simplepassivecashflow.com/QRP. But to me, I'm not a fan of the self-directed IRAs because you have UDFI tax if you're using leverage. And as we were what I've kind of reiterated more in this last 3 weeks is that it's not really how much you're making. It's more how much taxes you're kicking forward, all the deductions with the bonus depreciation. And then something that got brought to me the other day is a lot of these syndications, you can write the PPM in such a way where it's return on capital. So it's not a gain, if you guys are following me there. So if you put in 50 grand and we return that 50 grand in the first 5 years, well, technically, maybe you didn't make any money because that was just us returning your money to you. So that's what I'm kind of asking the CPA right now. But those are kind of the tricky stuff that I'm wanting to kind of get better at. And I think that is all how you word the PPM and the agreement. Right? I mean, it's all that change your facts, change your tax stuff. But just some ideas for your infotainment here. Page 195. I'm really big into if you guys have a side hobby or something you're passionate about, like doing clay pots or flying drones, create it into some kind of a business that you can sort of change your facts on what you're taxed on. Anybody want to kind of got something? Maybe we can kind of brainstorm around it.
Yeah, I think that's like I said before, where you do some kind of e-store or something where you either selling something, or if you rehab and start a little rehab business or something like that. So you have all these other write-offs you can put in. Like you said, just some kind of something that you can offset the income.
Yeah. So what I'm trying to get to more is and I talk to a lot of my higher end guys, look, you're already going to be financially free. You're already financially free. stop doing stuff for money, right? Do it because you actually like to do it. So that's kind of the brainstorming question here, is figure out something you enjoy to do to build a pseudo business around it. Right. Like, I mean, I think eBay is great, right? But I don't know very many people are super passionate about that. You know, I mean, maybe some people are. I mean, I kind of was. But
I'll do like my dad did, go be a golf pro.
right.
Yeah.
Any other hobbies people care to share? Maybe we can work
A question
on it.
about this part about like how if you form like a property management company to kind of manage your assets, you can then write off more stuff, you know, because it's a business. So like anything related to the property management.
Yeah, it's totally separate. Yep, exactly.
Properties, right? Like,
Okay, so what kind of things could we buy? And like trash cans, fire or garden hoses, yard stuff.
Yeah, anything for like an office,
pretty much it. Well, like
employees. Yeah.
Like if you run a furnished rental, right? Like for example, then like pretty much anything related to the rental could be business expense, right? Like so, like I'm wondering though, like if like if you have like a property management company, right? Like, and then you like lease space to the property management company, right? Like from your one of your properties, then you can kind of arrange like a some kind of percentage that like is logical, and then I'm wondering if that's advantageous to do that, kind of a shell, property management company.
Another thing that along that line is, as you're talking about that, was like, like stagers, right?
Yeah.
Mm-hmm.
Like maybe you can just like sort of just have a lot of nice furniture in your house, and that's just you just happen to inventory it in your house. Now this is getting very kind of gray hat, black hat tactics here, but just another thought.
Yep.
I mean, I because I do like a lot of like video stuff. I bought a drone last year. I never really got to use it, but
You should get good at it. I'll hire you.
Yeah, you in Hawaii too. It's like you can get a lot of good stuff.
yeah, actually what I'm gonna buy is like a 3D camera. I think that'd be kind of neat.
Oh, the Matterport one.
Yeah. Oh yeah, that thing is nice.
Yeah. Those are cool.
Really nice, and it's expensive, and you can write that up. It's pretty
Yeah. Any other hobbies you guys do, and maybe we can kind of brainstorm it together?
I have another friend that bowls, and he buys bowling balls like every 3 months. He's buying a different bowling ball to try it out, and he's writing all that stuff off because he's trying to. He plays in different tournaments and stuff. It's crazy, but that's like he does that and actually writes it off. So.
Yeah, I think anything sort of turn it into a coaching business.
Yeah.
At some point.
Yeah, you can do a coaching business with anything. Yeah.
Right. I mean, of course, the realtor thing is always the default one for real estate investors, but I think you got to figure out, if you're a passive investor, you got to figure out some other way, because it's hard, in my opinion, to justify this stuff. Your CPA might have a different opinion, but I'm just thinking logically here, but that's not always the case, right?
Yeah. I know he kept saying you can bend the rules, bend the laws, and he didn't say break them, he kept saying bend them. So.
Right. But if you're out here buying drones and doing all this stuff and you're just a freaking passive investor, it's pretty like, that thing's going to break at some point.
Yeah, you flying the drone to check all the roofs. You can do that as a side business. All right, I'll check all the roofs on all these properties.
Yeah, but your house is in like Birmingham. Like, come on now. Like,
that's a lot of battery power.
Yeah.
And solar power drone.
Yeah, I'm just checking out the other roofs so I know what to look for. Yeah, I don't know if that one's gonna go over. All right. Hey, yeah, that was all on page 95. Page 197, startup costs and amortization. And this is, I think we were talking about this, Troy. I got you on this. So you can't write it off till you make money and you start up.
Yeah.
201, the accrual versus cash. I always just go cash. It's just easier. On one of our bigger deals, we're doing accrual, and it's just kind of annoying, if you ask me. It's not logical, or it's just not what I'm used to. Page 202, offshore planning. We kind of talked about that. 218, I never realized that, yeah, you're not getting all the deductions off the mutual fund stuff. That's a nice one to tell your friends why, another reason why not to invest in mutual funds. And just a side note on the self-directed flipping, they talked about how you can get the tax benefit, or you should trade stocks in your self-directed IRA, and that was fine. But in what I've heard is you can't really flip houses in self-directed IRAs or do 1031, because the intention is not a long-term hold. The intention is to flip it short-term, and the intention of your retirement account is long-term. Something to think about. I think the 1031 exchange is for sure like that. You can't flip in it. But what is your guys' thoughts? Can you flip in your self-directed IRA?
I think you can, because I mean that's pretty much what, if you're doing stocks in there, you're still doing the same thing, because you have to keep it over a year before it turns into a long term. But most of the time, like with some stocks, if it goes up a little bit and you cash out and it's in the IRA, you don't get taxed on it. So to me, it's almost the same as flipping the stock in less than a year. If you can get in and out of a house in 6 or 7 months, you can get away with it. Or just not really 1031 and just like buy it, turn around and sell it. As long as all the money goes right back in, I think you're okay.
If you lose money in a flip, can you write that off as a loss?
I think so.
Not really, because it's in the IRA. So the gains.
No, well, if it wasn't in IRA, just.
Oh yeah.
Yeah, normally.
Oh yeah. If it was like, yeah, if it was separate, yes, I'll say yes. Because you put everything in and you didn't get anything out, so it's almost like taking a loss on the stock. Yeah.
Yeah, it's capital loss.
Yeah. Do that times, you're broke.
Yeah.
I think you can.
Page 224, 225. Do you do your stock trading in a Roth IRA? Never pay taxes on the gain. This could be a good way if you're playing around with Bitcoin. In my opinion, like something that's, high risk, high return.
They say you do that with anything inside the IRA as long as you don't touch it until you're 59. So
yeah, I think that's the designation, right? The intention doesn't really matter.
Yeah.
I think you're right. All right, now we're getting into some of the exotic stuff. Oil and gas. Have you guys ever heard of oil and gas investments?
Yeah, I'm still trying to see if there's any way I can get into some of it for the supposed tax benefit to be able to offset active income. But everything I see I haven't seen enough yet.
Yeah, so I'm speculating here, but I'm probably right. There's developed wells. Those are so your turnkey wells. And then there's exploratory wells. The government wanted us to fund exploratory wells. Has something to do with the conflict in the Middle East and all that stuff. So they put all these tax favorable gains and rebates or credits on oil and gas exploration drilling. So they call them IDCs. And basically, if you put in, I think they said 100 grand, you get like 30, 40 grand back in credits. Oh, no, deduction, I think. Yeah, so I've kind of done a little bit of due diligence, talked to a few operators. The guy I was going to talk to on Monday missed my call, so I'm not going to work with them. But it really is he used the term wildcat, which I only know is from football, which is like a really like gutsy way of playing football.
Yeah.
But that's kind of the nature of it, right? You're drilling for oil, and you can drill each well. It sort of costs around $200,000 in that magnitude, and it's like either you make something or it's $200,000 loss.
Yeah.
And I it's hard to get these guys to give me a straight answer, and it only happens when I get them on the phone. But the success rate is like a little bit worse than a Major League Baseball batting average. Like if they drill like 10, they'd be lucky to get 2 or 3 wells. But then the returns are very strong.
For the wildcat wells, right? I mean that's wildcat basically exploratory, right? So they're drilling somewhere where they haven't proven with actual drilling that there's anything there.
Did the football did this come from the football term, or did the football term take the wildcat drilling?
I think it came from football came from the oil.
Yeah, that's what I think.
Yeah, I was looking at a couple, and they were saying, we're comparing what we're drilling now to a well that was like, say, 60 miles away, and it produced this much. So, I was like, eesh.
Yeah, a lot of like fly-by-night operators in this space.
Yeah, so I mean, I've heard a bit about it on other podcasts, and I mean, if you're going to do straight wildcat, that's high risk and speculative because you don't know enough about geology and such to know if you're making a good bet or not. But the development wells you can get into. I haven't done it, but a development well it may be not quite as extreme as what 60 miles away, but it might be. They drilled one well and they found something. They drilled another well a mile away and they found something, and then their geologists believe that the structure is tied together, and they're going to drill another well in between. So there may be a good chance that they're going to hit because they think everything's talking to each other underground there, but there might be faults or anything that could cause it to be different there. So
It's totally different.
Yeah. So when talking to these guys, they're really like, these guys are kind of like talking to insurance contractors. They know the game, and I don't really know if they're telling the truth or not, but they say things like, oh, well, we have that currently developed well, and we'll put it in this fund. We'll compile a few of these wells together so you get your IDCs. Oh yeah, we'll throw in one developed well, so there's cash flow. But it'll all be kind of commingled as one to get the wildcat, the IDCs. And you're kind of like, how does that happen? Like it's just a checkbox that they do, it seems like, to get it so you can get your IDCs, right? I mean, it's kind of colluding against the government in a way, but that's the kind of stuff that is out there. I don't know. I'm not comfortable with it, but it's about as far as I went into it. But it definitely is like, if you're taking a big chunk out of your 401k and starting to take control over it, this is one of the ways you mitigate for that big AGI bump, this and land conservation easements. So on page two, go ahead.
If you can expand, if you have a second, with the land conservation, I don't want to get too far off track, but just if you want to,
so I think we talked about it in the first session a little bit. So we kind of talked about it a while, so you can go back to that one. But
okay.
Basically that one is a charitable donation and they will give you the value to 5, or I think up to 5 times the land value or the highest use. So like, you know, like let's just say you take a box of clothes to the Salvation Army. In a way, they'll let you like evaluate it that you have like a Versace jackets or something like that. You're taking a big chunk of money to that.
Okay.
So a lot of times, you know, if you invest like 100 grand, you can get like almost 5 times the credit or the deduction. So 500,000.
Yeah, I've heard that's like based on the appraisal value of like its kind of highest and best use. So like when it's developed, even
Right.
if like it's not developed at all, and it's just used for like equestrian purposes.
Right. But they have to give you that highest and best use. Exactly.
Okay.
So the last thing here is that page 232, deductions on running a farm or orchard. Thoughts that came to mind was like, maybe this is why people have wineries, right? I got a partner, he kind of lives out in the sticks a little bit, and he's got like a few, it's zone farmland. So I think that's one checkbox you had to hit. But he's got like a few apple trees or something like that. And he said if he planted a little bit more, it would qualify as a farm or orchard. And then supposedly then he can get these tax deductions for it.
He just goes out and pulls a couple of apples. That's too cool.
Yeah, I mean, I think if you're following the why behind it, my understanding is like the government wants to subsidize farmers, right? And this is where they've done it.
Yeah.
Any comments on this one?
I don't know anything about that.
I mean, I talked to this other guy. This is unrelated, but this guy who like a religious priest in that facet, and he told me that they can write off their whole like housing, you know, their house, because before men of religious affiliations had, you know, they lived in a church, but then when space became less available, they had to kick them out and they had to go find their own housing, but they still wanted to, you know, subsidize these guys in a way. So I don't know exactly how that one works, but if any of you guys want to be deacons or rabbis or whatever, there's still a hope. Maybe that'll give you a kick in the right direction. If you don't have a hobby, maybe that might be yours.
Like for nonprofit, right? You can just like
exactly, yeah.
Nonprofit.
Yeah, I don't know if it's a I think it's got to be like a registered religious affiliation. I don't know if a nonprofit counts. I don't know.
But yeah, there's a lot of churches and like temples here that take advantage of that.
Oh
That's
yeah.
kind of the only way that they're able to, you know, survive in the high cost of living here.
Right. But this would be for like the staff. So like if, you know, you wanted to go volunteer your time as a deacon, part-time or whatever, you can live in your own house, but supposedly you can write off your housing costs. I don't know how much, you know, I don't know how you would do that, but hey, I'm just repeating what people say to me and something to look into.
Well, the farmland thing is kind of interesting because there's like actually people running religious organizations on like farmlands, like
Double dipping.
It's like stacking.
They should split that off.
Yeah. Whichever one makes the money, they write it off with the other thing. That's cool.
All right. Now I don't know if you have a Pocololo farm in your house that counts as a farm, but I don't know if
States that's legal, I guess.
Yeah, it's got to be legal, of course, but
Move to Colorado and have a reef in the backyard.
Yeah, so that's the book, guys. Any other comments, any other ideas, any other questions?
I guess in general, like, did it change your real estate investing strategy as far as tax purposes at all? Like,
Yeah, so maybe I'll do a couple takeaways, and if you guys want to do a final takeaway, that'd be good too. So my takeaway on this one was the whole active passive thing, and having a spouse that is a real estate professional, so I can take advantage of those active losses. That was my big takeaway. Anybody else had like a big action change, or I had to go do this, or no? I'm
along those
thinking.
lines, like the spouse, like if you made her like a property manager or your property management company, that then like then you can just charge like 20% to yourself as the client, and the spouse is like, that's like the primary thing that they do is just manage your properties, and they drive around and pick up stuff, and various like errands could all be tax write-offs, right?
Yeah, like I don't know if you wanna. I don't think you need to pay them that salary. What do you kind of think in there? Is that
like, because then the property management company could then lease the real estate from you, the owner. Like, so like you don't actually. Like, so then it becomes a business. It's like your personal like primary residence could then become like kind of like your business like operation, because like you're renting it out to your company.
Yeah. So that was something I never really grasped. Like if you have a portion of your house that you are using for your home office, and you're taking deductions off of, and then you sell your house, do you have to pay recapture on that portion of your house that you took?
You do. Yeah, it's not really. It's just deferred. It's not like gone.
Yeah.
Is that you do have to pay it. But no, I was just thinking about the the spouse being the full-time real estate professional status for the passive loss thing, right? Like, so like that's an interesting way. Like, you structure it that way. The spouse is the property manager who runs the property management company, which rents the real estate from you, the owner, right?
Right.
You can get that passive loss. But I don't know. I'm not sure. Is that all like legit?
I think it is.
Yeah, it's another way. I know that people, like, they have a retirement home in Florida, so they make the retirement home their primary residence, and then they do business out of Texas. So they have a nice apartment in Texas, and they do all their business here, and so they're using the business in Texas, the whole apartment and everything, because their primary residence is Florida. They're writing everything off that they're doing in Texas. So, they have like a real estate coaching business and everything, and they just do everything here. And then when they're at home in Florida, that's their primary residence. They just make that their primary, so they write everything off. So I wouldn't go that far, but I know there's people that are doing that. Pretty interesting.
Yeah. All right. Anything else for the group? It's like happy hour is finally here in Hawaii, and if you guys are interested in more things like this and joining the new mastermind, check out simplepassivecashflow.com/journey, and that's that course that I'm putting together, 27 weeks of content and bi-weekly calls, sort of just like this. Again, at simplepassivecashflow.com/journey, and I'll see you guys next book whenever we do these things next. All right, bye.
You guys.